We pray for better days.
Hello everyone, welcome back. Another video today. This video is going to be on the subject of how you as an individual have many advantages over somebody who you might employ as a wealth manager. So the first thing I'm going to say, not all financial managers or wealth managers are bad. I'm just going to merely say that you personally are in the best position possible to manage your own money versus anybody else in the world, and I'm just going to go into some of the reasons why. So we're going to get into some of the disadvantages of having a financial advisor, but first of all, let's just talk about some of the advantages. The advantages would include, obviously, if you've got absolutely no understanding about how to invest your money or your finances whatsoever, they'll be able to help you purely based on that fact if you really don't know the first thing. But what I'd hope that you'd learn is that with a few simple steps just to educate yourself on how you might do that and invest in the long run, you'll be able to see that that's actually really quite a straightforward thing to do. As well as that, they do act as a third party, as a mentor sometimes, because they'll be able to offer you a shoulder to cry on. Today is the 23rd of September 2020. No one's quite sure where things are going to go at this point with regards to the coronavirus pandemic and what effect that might have on the market. In times such as this, further down the line, should you employ a financial advisor, they'll be able to offer you advice on what to do next. We've now talked about the advantages, let's talk about the disadvantages. First one I'm going to talk about is the fees that financial advisors charge. A financial advisor will charge you fees maybe in the region of about 1-2%. Now that doesn't sound like a lot, but over time that can add up to quite some degree. In a moment I'll show you a graph on the computer which will be able to display to you just quite how much this adds up over time. Your interests are not always aligned with their interests. Their interests are to make as much money as they can from themselves or the company that they work for. Your interests are to generate the greatest return on investment as you can and hopefully have a nice tidy pension pot at the end of the day. This 1-2% that we talked about, that chips away at your money every year. It's less the money that you lose through that 1-2% and more that the money that you lose going forwards that you would be able to invest otherwise. Because of these fees that I've just spoken about, it's actually really difficult for a financial advisor to make money over and above what investing in a large index fund would generate from you, a large passive index fund. The reason for this being, they're already at an uphill or a huge disadvantage, an uphill struggle, because that 1-2% that chips away every single year, that deducted in terms of fees, that will mean that they've got less money, less buying power going forwards. You have to be careful as well because a lot of these people will attempt to sell you products that they have a vested interest in, i.e. they're on commission. When you're investing your own money, you don't have to worry about these things. You do your own research and you're away. So like I say, this video is merely just to educate you on some of the reasons why a financial advisor can be a bad idea. I'm not by any means saying that it's always universally not a good idea to do that. I'm just saying that there are some distinct advantages that you have with regards to managing your own money. If you're going to do it, just please read the T's and C's, shop around, just give yourself a good idea of what to expect. So as I said earlier, I was just going to show you some quick things on the computer which will illustrate what I've just been talking about. This is the illustrative part of the video where I'm just going to give you a quick idea of what to expect from a wealth manager and the sort of charges that you may incur by acquiring one of their services and how you can avoid them. So if we have a little look at this, this is a Hargreaves Lansdown website. This is a breakdown of the charges of some of the passive funds they have. Now, when I say a passive fund, what I mean is there's no one behind the scenes managing it. These funds, they strictly reflect the movements of stock market indexes such as the FTSE 100 or the S&P. So because of that, they're completely mindless recreation of those things through which you can invest into those stock indexes without having to acquire the services of a wealth manager or anything like that. So because there's no one behind the scenes managing them that you have to acquire the services of, the fees are very low, as low as you can get through buying funds. So let's look at this one at the top. So 0.12%, incredibly low. We'll scroll on down here, 0.08%, things like that. These are the sort of fees that you can incur by managing your own wealth. Now, I know this isn't strictly the same thing, but we're just using this as an illustrative example to compare how much it costs to manage oneself's funds versus hiring someone else to do it for you. So you've got an idea of how much it is for you to manage your own, 0.12%, things like that. So that will mean that every year 0.12% of the money in that fund will be deducted to pay for the management of the fund, or to pay the fees of Hargreaves Lansdowne to fund their outgoings. On the flip side, a wealth manager, there are active funds as well. They're typically in the region of 1 to 2%, something like that. So 1 to 2%, you're talking, it looks like, well, if we times this by 10, then you can see the fees are almost times 10. And that mightn't sound like much, but I've drawn up a little Excel chart here, and you can just get an example of how much this will affect your wealth over the years should we be thinking about long-term investments. So if we look at this, if you expect a 3% return every year, you get to 20 years when you're due to withdraw your retirement, your pension, then we can see here that this is a difference of almost 300. If you get 5%, it gets magnified every time you increase the percentage levels. And then if we get all the way up here, you can see 6,700. 10% is a very healthy return on anyone's account to expect every year. So it might be a little bit unrealistic, but you can see how small differences build up over time, and therefore why it is advantageous to manage one's own wealth. So just something to think about. I hope you found this video very useful. Some of the stuff in here I wish someone would have told me a lot sooner anyway when it came to managing my own personal finances. If you've got any questions, you know where I am. Really helpful information. Hope you've enjoyed the video, and I'll see you all soon. Thanks for listening. Goodbye.